Alright, gonna go ahead and get started. The chart requests will go from price on down, so I'm going to do the highest price stocks first, on down to lower price, so starting with big boards such as Google and Netflix, and then kind of mid caps or mid price stocks, 1 to 10, like CPRX and MACK, and then a couple penny stocks, BRND, LQMT, among others. So we're going to start with the SPY, just the ETF that tracks the S&P 500, and S&P closed at 1692. SPY on Friday closed right around 169.10, 169.12, but then it shot up after hours and was up about 50 cents in the after hours session as well. Yeah, you can see the run on SPY into the close, about 20 cents, 20 cents. And then starting at 3:55, last 5 minutes of the day, big volume. And then first 5 minutes of the after hours session, 4 o'clock to 4:15, SPY rallied from 169.20 up to 169.40, ended up closing out the session at 169.60. So first thing I want to say on the SPY, regardless of where it is on a longer term chart, is this has been a momentum market in the S&P 500, in the general indexes. This has been a momentum market. After hours on Friday and into the last 5 minutes of the day, you saw a lot of momentum come in. So right away, what I feel like going into this week to keep in mind is want to see kind of a gap up tomorrow from the SPY to kind of continue this strength that it's been showing with the close up here on Friday. Nice strong close at an all-time high. So I'm making a little note here in my notebook, just that SPY had lots of momentum into close and after hours. So want to see a gap up. Or if no gap up, I'd want that gap down to get bought and kind of be that first low of day and be the one that sticks. And you've seen that on a number of occasions here with the SPY. Okay, so that's just the immediate term read going into tomorrow at the open, pre-market and what you're watching. And then if you look out on a daily, SPY is at all-time highs, and it's had another three-day winning streak. Last one ended up being a big-time run, so that's another factor that the last week, 2 weeks rather, that 3-day winning streak turned into a 7-day winning streak. Overall, since the June 24th bottom, the 2 times SPY has been able to rally 2 days in a row. It's went on to a 3rd day in a row higher. So now you want to see this 4th day be in the green and look out for those back-to-back red days, because that's something SPY hasn't shown since this bottom. Okay, but the reason I say I want to see any type of weak open get bought or not get sold too hard is because you simply haven't seen that during this rally. If you look even on a day like June 28th, when SPY did gap down, closed on the 27th, 161.08, opened on the 28th, 160.63. So about a 50 cent, 40 to 50 cent gap down in the SPY, but ended up closing at 160.42 off of a high of 161.40. So there was a low at 159.80, right? But still had a nice ability to go higher as well. So that's why if you gap down, you want to see that weakness get bought or a marginally lower close. You look at something like the NASDAQ, which sold off on Friday, but SPY was able to hold up well, even managed a gain of 2 points. And a lot of that has to do with what's going on in the financials. Okay, you look at XLF, which you must look at if you're going to look at the SPY. So that's another thing I want to make note of is, you put XLF and SPY over each other, and you can see very strong correlation. You can see both of them June 24th bottom. Okay, so you definitely have to follow what XLF is doing when watching SPY. And it's likely that SPY can continue to do well as long as XLF, the banking sector, is doing well. So a name to keep an eye on with the SPY when trading it or watching how it's going is you take a look at BAC, Bank of America. Okay, this thing, you consider the rally off of June 24th, that from where it came, and now you look at Bank of America, June 24th, this thing was at $12.30. Now it's up to $14.70s. That's a rally of 20%. So a name like Bank of America has definitely been helping lead SPY higher. And, via the XLF. And you look at this volume on Bank of America, and it's coming in very, very high. Had highest volume back-to-back days. One of the better stretches of the year over the course of 2 days. But anyways, back to kind of SPY exclusively here, because there is something to point out that you've got to realize right now. A lot of funny looking gap candles on the SPY that you haven't seen very often when looking out over the last 100 days. Candles without bodies, dojis as they are referred to. And what they imply is that wherever SPY is opening, while there are some ranges being made that day, from an open to close basis, that is where it's opening the day and where it's closing the day, SPY has not been making much vertical movement in either direction. Since June 24th, you've 1 day, July 3rd and July 16th, kind of better range days on an open to close level. The 18th was decent, but so that's just something to be aware of. And on the July 3rd, when there was a decent range, it was off of a gap down in the SPY as well. So that's why I'm saying gap downs need to get bought. If you see a gap down start getting sold, then that's your first sign of a little pullback pending on the SPY. In regards to specific price levels to watch, SPY's been doing a good job now of staying up between 168, 167 over, from the 12th since the 17th, that stretch, and then the last 2 days now it's put in lows into 168. It's kind of moving out of that 167 on the low side range. You just want to see SPY put in a higher low. 168.31, Friday's low, that's an important low to watch. And above that, just the over-under 169 trade. I always feel like it's best to consider at the core a simple trade and a simple setup, even maybe if you have what looks to be a complicated pattern, try and find some simplicity to it that you can make sense of. And to me on SPY, it's over under 169. That is over 169 and it's going into the 170s. Under 169, and now we have a potential pullback on our hands with a focus on that 168.31 support level. Below 168.31 and just kind of the 168 level, and the 165 could be an area you see SPY pull back to, because if you look out just kind of over the last, if you looked at a weekly chart, let's see, you could see that back in May, SPY kind of channeled around 165. A lot of different openings and lows and just congestion around that 165 level, that once SPY was able to solidify itself above it last week, this past week now, it's had a nice rally. You look at the weekly chart, first time in SPY's history that it's closed back-to-back green weeks above 165. You look at the week of May 13th and then to the next week and beginning the 20th, that was back-to-back weeks above 165, but that second week was a red close on the weekly basis. So that is something, you know, of a level where if you start cracking below the support, which has been on a very near-term basis, then you might be able to pull lower. One thing I like to do when looking at a trend is identify something that hasn't happened. So that way I see it happen, now I maybe think that a trend change might be underway. And in looking at the SPY, it's never really been able to gap down so far since June 24th and then press lower the next day also. You know, kind of consecutive gaps down. You see, you had a gap down on June 27th to June 28th, but next day you gapped higher. Day after that, you then had another gap down from the 2nd to the 3rd, but that day you closed green. So just overall, and then again, I believe you gapped down initially on Friday. Not that much. You didn't gap down that much on Friday. But overall on the SPY, you know, watch out for gap down and weakness on second day. You know, if there's a bad day, but then it's followed up by a good day right away the next day, then that kind of represents volatility, but it doesn't necessarily represent downside momentum building. You need to see a weekday or semi-weekday, then followed by a second weekday. That's been missing so far in this SPY rally. You know, other thing to keep in mind on the SPY, just broader term, is on that monthly chart, you're set up for a positive month right now during the month of July, as long as you stay above 160. So this has been an extremely bullish month. But on that monthly chart, you tend to go on rallies when you have a green month. If you look at the times when it's only been one green month by itself in SPY, there's really not many. And you know, some of them was December 2008. That was the first one since this bull market began. You know, market bottomed March 9th. But when it only has one green month, such as July, April 2011, you know, then you had a little bit of a pullback. You've also had a time, though, July 2010, where you had a single green month, and then that red month was followed up by a streak of green, but that one red month was a very negative month. SPY went from, a 110 close down to a 105 close during that month off of a 113 high. So, and October 2011, that green month was after that 2011 lone green month, followed by 4 months lower. That was near a bottom. But so there just haven't been many times when SPY's rallied a month in one month and not followed it up with a multiple month rally. And when it doesn't, it's been something to look out for. So that's something that going into August here, these last 2 weeks of July, week and a half, you want to just keep that in mind and mark where SPY closes. All right, moving on to Google. So Google, first thing I'm going to say about Google is big down day on Friday from a volume perspective. A lot of selling that day, at a price that off of its all-time high, Google is, let's see, 3% off of its all-time high at Friday's close, and you had a lot of selling go on, as evidenced by the volume, and that the price was lower than the previous day. You can say there was more supply than demand until it was able to drop down to a lower price. The thing about that, though, is if you look over the last 50 days, the selling came at prices that are still above what is ultimately Google's key support between 855 and 865. Or if you want to get really technical with the price point, the June 6th low of 847 to the June 24th low of 863.25 on Google. So my point is this could just be a channel dip, and this could be a great buying opportunity. And Friday might have given you your first hint at that as Google, finished 2.5% off of its low and close to the high than it did to the low. A couple reference points I'm watching in Google is number one, that simple trade, over under 900. Stabilization above 900, this close to all-time highs, and Google's an interesting trade because everybody knows, it's only 100 points away from 1,000. At this point, to move 100 points from 900 is only an 11% move on a stock that's made a 30% rally over the course of the year. Seems very doable. But the key to the Google trade is stability above 900. Until it shows that stability after this high volume down day, then you can short it versus that 900 level. The other level to keep an eye on is just the overall midpoints of the 928 all-time high to Friday's low first of 875.61. You get a midpoint again right around 900 of 901.80. So what you can even do is make it this over under 900 to 902 trade, since that's where we know the midpoint is. And I will show an example recently of volatility within a midpoint, as well as citing that it can be a good trade right away. You had Tesla be very, very volatile this past week. Dropped huge from 133.26 high down to a 107.30 low, or sorry, 104.50 low, which left you with a midpoint right around 118.88. And on Tesla, the big day that it bounced, you could see that right where it stalled out was just below that midpoint, 118.50 earlier in the day, 118.05, 118.65. But then once it started creeping up above that midpoint on an intraday basis on Wednesday, July 17th, getting some closes above it on an intraday basis, Tesla then made a further rally from 118s up to 122. So Google is the same thing, you know, big bounce, and now, you know, Tesla also stabilizing around the midpoint. But back to Google, with the midpoint at 901.80, you want to watch for continuation of this rally from Friday's low. Do you go above that 900, 902 midpoint area range to kind of signal that that long trade is definitely back on? It looks like it's back on, judging by just the day Google was able to have on Friday off of the low. Okay, big, huge move, you know, $20 move in a span of about an hour and a half, 2 hours. But if Google fails at getting back above 900 to 902, then the first level to watch is Friday's opening price of 886, you know, on down to 885. 885, just simple $5 level. You know, like to think about 5, 10s, 15s, 20s. Just keep it simple. The higher the price gets, because at that point, percentages are less and less in between dollar marks. So that 886, 885 where Google opened, then 875, you know, would be in play if you kind of break down there. But in between 890 to 900, I kind of think Google just needs to hang out and maybe drift sideways. The one thing that's interesting is it did have a 4-day losing streak with Friday, and rarely do those really hurt the stock going out, you know, a couple weeks. If you look at the previous four-day losing streak, early mid-July, you know, that was a bottom, 864. It then rallied. You had the one here towards the end of May, and that preceded a weekly bottom, you know, 1 week, 2 weeks later. And then again in April, you had 4 down days in a row on your way down to what was a bottom before a big rally. So 5 down days in a row on Google. If you get that other dip, you haven't been down 6 days in a row in quite a while, at least not in the last 180 days. So basically what I'm saying is, to me, the Google trade makes sense as long as it's holding up here, and even if it's down tomorrow, because you have the odds going in your favor based on the fact that you haven't had a 6-day losing streak in at least the last 200 days. Doesn't look like you've had one in the last year, even last 2 years. Maybe one in 2011. Yeah, so you had one in 2011, November 2011, but that was also taking you down to a weekly bottom in Google. So bottom line is if you get some weakness tomorrow, I wouldn't want to short it. I'd rather short a bounce at that point that fails to get above 900, or weakness that's then followed by a green day where the stock still fails to then get back above 890, or, you know, it had moved below 885. Really just depends on what that reaction is. And a question I'd have is, does it get above 902 and consolidate, or does it consolidate before 900? If it's consolidating below 900, not before, sorry. If it's consolidating below 900, then it's going to become, well, does it get 900s first or 880s first? Because then that sets up a nice potential breakdown trade. If Google's consolidating in the middle of the channel after a down move, then you might come back lower, test this lower channel. The bottom line, stock is healthy in my view, and this shouldn't be a surprise to people who have seen Google trade over the last few years, because even though it did break out recently, you look at the breakout in September 2011, you then had a big down move off of earnings, but the stock was able to find its way and trend. Once again, Google usually gets a nice uptrend, so until there's more damage to the chart, I would trust the uptrend and buy versus some of the reference points I've outlined where maybe you start shorting if it fails to get back above 900. Okay, Netflix, another big board stock that's been on just a massive run, has earnings coming out tomorrow. Personally, I just feel like it's going above 300. 300 kind of looks like a magnet. Anytime a stock goes from $50 to $300 back to 50 and is able to get this and get back this close to 300 again, I feel like it's got to happen. It's a magnet. So the one thing I'll say that's very important though on Netflix, the momentum has to continue. All right? Because you look over the last year on Netflix, the way it's coming off of the bottom is involving gaps. It's either gapping lower, like in October 2012 when it bottomed. There's a gap down, that was the bottom, and then just ripped higher, all right? And then on the last earnings in the first week of 2013, first earnings season, last week of January rather, first month, big gap up and never really fell below the gap up low, and then a rip higher, and then, we know what's happened since that time too. April 23rd, huge gap higher. And once again, most recently, June 14th to June 17th, big gap higher. That gap ended up filling, but the stock's been rallying since. So Netflix's momentum moves are associated with gaps. So if you're in the long Netflix trade or in the camp that says it's going above 300, you either want to see a gap up and hold or a gap down and bottom. What I mean by that is if the stock were to gap down off of earnings, then you'd want to see it hold whatever low it puts in that day and finish off of the low, such as like it did back in October 2012 when it gapped down, opened 57.85, the low was 57.40, closed at $60. So that's really our only last reference point of earnings gap down. And that was about a 3 to 3.5% close off of the low a day in Netflix. I can't try and guess what it's going to do off of earnings. I don't know. Who knows? The trend would suggest it's going to gap 30, 40 bucks higher and consolidate above 300 and then start running. But my sense on Netflix is you don't really guess the direction with a whole lot of money. I mean, the lottos are good if it works, but you look at the premiums on Netflix for tomorrow, and the $300 calls are going for $5.70. The $225 puts are going for $4. So the implied volatility on this thing is just ridiculous. So if you look at it, let's see, why does it always do this? Basically, market's looking for a ridiculously big move in Netflix the day after earnings, either to be much, much, much higher or much, much, much lower. But let's look at volume here on Netflix on those options and see, 1,000 open interest on the 300 strike calls. That's the largest open interest of any strike. Well, the 275 has 1,100 open interest. So people are definitely seem to be looking for that big move higher and just the overall volume, call volume versus put volume, looks like it favors calls, as you'd expect going into a report like Netflix when it's gapped up, insane amounts the last two reports. So just the day after earnings, which is Tuesday, the reaction, any gap down that finishes off the low doesn't break this trend. In order for the trend to be broken on Netflix, it's got to gap down, lose 250, stay below 250, and have weakness the second day. Netflix off of gaps higher. The next day, on that second day, it's been moving higher both days, never really sustaining a move below the next day's low. For instance, you look in April, or the previous day's low. You look in April, Netflix gap up off earnings. Next day, held the low. Held that gap up day low. So that's what you want to watch for. Overall, I do think this thing can gap up 70 points. Again, something ridiculous. Wouldn't surprise me in the least. I've never really traded Netflix. I've just kind of watched it. It's a crazy beast. And right now, it's a beast that's just going higher. A few years ago, it was a beast that was just going lower, but that is the market. And also, if you look, this trend higher is similar to the last trend higher, the one that started. If you look at what it was doing on the way up to 300 the first time, it was gapping up and then running, okay? Same thing, October 2010, November 2010, January 2011. But look at when Netflix gapped down one of the times in April 2011, the April 2011 report. Gap down, went below that gap down day's low the next day. That ultimately ended up preceding a much further sideways consolidation, albeit before Netflix still ended up moving higher. But the point is, the gap down that was then followed by another move below that day's low led to sideways, whereas the gap up that holds that low is leading to a further move higher. So that's really what you want to watch for. Also on Netflix, it's made big moves the last 2 days going into earnings. The last two final days of its earnings report, meaning so tomorrow's the day ahead of earnings. Made a big move in a similar scenario. And if you look on Netflix when it makes big moves, as you'll see with most any big board stock, when it holds the initial 3-minute lows, such as it did on Friday, July 12th, and then holds the initial 6-minute low, meaning it doesn't go below those first lows with each other, 933 to 936, and then 936 to 939, stays above those two lows both, and you get a higher high right there. That is a good kind of go with it signal on Netflix, where then it rips higher. So tomorrow might be a day to play some of these insane out of the money calls on Netflix if you see it holding the initial 6-minute low, 3-minute low, and making new highs by 942. And a simple way to do that is you mark high day, you mark low day at 936, write it down, and then what's the next move? Do you move $1 above high a day or $1 below low a day by 942, 945, and then chase that direction? All right, moving on to IBM. So here's a good example of a stock that gapped higher, couldn't hold that gap higher day's low, and has moved lower Friday by a good amount, already gave up the move from earnings. And make note of just the simplicity behind IBM with where it was recently at. Opened right around just underneath 200 the day of its earnings reaction, moved to 294, closed below 200, and next day, moved lower. Simple trade, over under 200 on IBM. You stayed under it that next day, and it ended up being a short. So IBM overall is still in a downtrend. okay? But it's in a downtrend within a longer term channel. Over the last year, IBM hasn't gone below its 2012 low, and it really didn't go above its 2012 high, with much conviction. Never was able to spend 2 or 3 green days in a row above its 2012 high. So IBM is just in a channel, okay, but right now got rejected in the middle of that channel from the last year, and looks like it wants to do a 190 test. 190 is key support on IBM. Below 190 and 188.41 is an exact price level to really focus on. Below that and the 2012 low of 181, 182 can be tested. So 188 to 190 is key support right now on IBM. And if you break that, 180 is in play. As for getting back up to the top end of this channel, you have to get above 200. So you can either trade versus 190 right now, or chase momentum on a 200 break, or short this thing kind of versus maybe 195, targeting a 190 to 188 test where maybe you then get a move lower. Also, if you look at the 3-minute chart, before I look, I would guess that there was something about Friday's move involving the 3-minute low or the 6-minute low that really signaled a nice downtrend off the bat. Okay, and here you go on IBM. This is a perfect example. You can see 6-minute low smashed through the 3-minute low, closed below it, and then you stayed below the 3-minute low on IBM, ahead of 942, stayed below the 936 high, ahead of 942, 945, and by 950 you were back below testing the 6-minute low. You actually closed just right at it at 945, so that triggered a nice directional move lower on IBM. So that's another example of the 3-minute and 6-minute low coming in handy. Dunkin' Donuts. This is a stock that looks like it might have came off of a top, but it's been strong all year. And the reason I say it looks like it might have came off of a top a little bit is because this pullback looks similar to the pullback in May, which preceded a month-long 45-day or so consolidation within a channel. 4 down days in a row, green day, then a red day. That's different than the 4 down days in a row at the end of June, which then was followed by a green, green, green. Okay? But while I'm saying that, overall, Dunkin' is definitely in a really nice trend, and it's been a strong stock. So it's one that you can continue to go long until it stops working. It just might be going sideways for a little bit first. Broke below some support from July 10th at 43.80, and it's been struggling then with the $45 level and has ultimately moved lower. You take Dunkin's $45 high and its low from June 24th, and you want the midpoint of that range, 45 minus $40.63. You get a midpoint of 42.81, 42.80, and that's really right where Dunkin' is. So just keeping it simple on Dunkin', the $43 to $42.50, in that range, 43 on down to 42.50, over under that range on Dunkin'. Under, you might come down, fill this gap below 42, and maybe even test that $40 mark. While above it, and you've got a good chance of either consolidating just sideways within a little channel or trending back higher. Overall, this has been a name that buying when it's sold off has been a good idea, but it's also up a heck of a lot, and the monthly chart looks like it might be a little topped out as well, as it's giving up all of its gains on the month. When looking at something like Dunkin', I feel like you got to glance at a name like Starbucks also, for obvious reasons. And Starbucks to me looks like it has a better uptrend in place, a healthier uptrend. Let's compare the gains though on the year. Starbucks came into the year at $53.63. It's at $68.79 right now. So just want to calculate that gain versus Dunkin' Donuts. So that's a 28% rally. And Dunkin' came into the year at $33.18. Right now is at $42.92. So this is going to be a stronger rally, I would guess. 29% rally. So actually they're pretty much right in line. You know, Dunkin' and Starbucks are having the same performance. Dunkin' is slightly better at 29% on the year versus Starbucks is 28%. But Dunkin' looks more likely to maybe have a little pullback here versus Starbucks. Starbucks also, though, you could see big down day on July 17th, kind of struggling to recover from that. Dunkin' had a nice down day July 16th. So if you're going to trade one, you got to keep your eye on the other, given that they're two of the biggest coffee players and just the kind of go-to coffee stocks in the market that I feel like. So overall, though, you know, Dunkin' 42.50 to 43, and if it breaks below it, could maybe go down, test 41 to 42. If you hold above it, good chance of a rally back to the all-time high. Again, you know, you look at Dunkin's 60-minute chart, it's had a hard time staying above the last hour's low. Meaning the last hour of the day, you take that low and you use it going into the next day. Over the last 10 days, Dunkin' hasn't been staying above that low, and that's really preceded, you know, the move lower, or shouldn't say preceded, but ushered in the move lower. So watch 42.90. That was the last hourly low on Friday. You know, can Dunkin' stay above that level tomorrow? Maybe signal a reversal coming on. Next symbol, GILD, GILD. Nice breakout Friday, super strong stock, has made a big rally overall over the last couple weeks, and over the last year it's up more than 100%. Just monster run here. So overall, looks like it's going on all-time highs. Yep, that's nice. So with Gildine here, or Gilead Sciences, tougher to really track the resistance levels. What I would rather focus on when trading a name that's making all-time highs like this is focus on time being spent consolidating once a big candle like Friday's is made. You know, if you look recently, July 12th, you had a really nice body candle that took you to a new all-time closing high, I believe. Yeah. And that day was followed by 3 days of consolidation within the top end of that candle's range. So you might have a similar setup there tomorrow on Gilead, although if you break above the high, which it closed right at high, 60.50, then this thing's probably got some more legs towards 61.62. If you look at July 10th, I would want to see, because that was a day where you had a nice day, then you gapped up that day. Actually, you opened flat, but then moved above the previous day's high, July 9th, and then gapped up the next day, and then on July 12th was you had the really bullish day. So GILD, you definitely want to see it hold right up near today's close, Friday's close rather, of 60.47. Just make it simple, 60.50. And it's shown you good potential to follow up Friday's candle with another rally on that fourth day. And if you look at July 10th, which was the fourth day of a 3-day winning streak, green day, held above stayed in the green. That day was a really, really good return. Okay, you look at another 4-day winning streak at May 14th when it stayed in the green following a 3-day winning streak. That fourth day higher, really nice bullish day. So those are the most two recent 4-day winning streaks. You've had some really good action, and that 4-day winning streak in May was also coming at all-time highs. So you're at all-time highs here. Just want to see momentum continue. As far as any type of pullback, when a stock's making all-time highs like this, I really don't see a need to kind of be a top caller. Let the stock call the top for itself, you know, and attack once the move lower is happening. I guarantee you, when stocks that make big runs start rolling over, tops aren't a $2, you know, 2-3% move off of a high. Tops are a 10-15% move off of a high. Once you start seeing something drop 3-4% and then still move lower, that's when you can still attack. You're still going to catch 12%. Trying to, you know, get cute and just fight the tape on something that's trending higher doesn't make sense to me, because the risk reward on making a 3% move on the short side versus playing the trend higher seems silly. Doesn't seem to make sense. Overall on GILD, you look on Friday, again, held the 3-minute low, held the 6-minute low. By 9:45, it was breaking above that first high. So just any big board stock really, and you might see it on penny stocks too, that is making a new high a day at 9:45, 9:50, good chance that thing's going on a run. So watch to see, does it hold that 6-minute low again? Overall, solid chart, looks like it wants higher. All right, now I'm moving on to, you know, stocks priced between 1 and 5, just about. First one is CPRX. First things first, really nice day. I would expect to gap up on Monday, but I would want to sell that gap up if I'm in this trade, because if you look at the recent history, June 12th, gapped higher, sold off. May 13th, gapped higher, sold off. April 22nd, big candle, gap higher next day, put in a low wick, opened 102, put in a low at 92 cents. Okay, so just overall, when this thing gaps after nice moves, it's tended to sell off. Furthermore, you look at where it is on the chart, and it's breaking into where I would expect there to be some supply hanging out from a gap down that occurred in November of 2012. So on a gap up, you know, consider locking in some profits and then seeing what it does from there. And then I always feel like you sell a gap up, and then if you have to buy in 1 or 2 cents higher, so be it. You know, that's why at least maybe you sell 50%, keep 50, sell 40, keep 60, sell 60, keep 40. You know, do what makes you comfortable. But the person requesting this asked if I felt like they should sell a gap up, and I would say yes. And again, you look at something like CPRX, also held the 3-minute low on Friday, held that first low a day, didn't hold the 6-minute low, but wasn't making new low days after 9:36. Overall, ended up trending higher later in the day. So you want to see, does it hold that first low? If it gaps higher, does it hold the first low? On a gap down, really this thing needs to hold. I'm not expecting it to gap down, but the best case on a gap down would be holding, at the opening price right away and just reversing higher. If it were to gap down and break that first low that it makes, say it gaps down to 117 and it's printing 116s, 115s, might pull back more. Overall though, nice move Friday. History recently suggests a gap up, but it's coming into key resistance, between 120 and 140. If it can get above 120 and hold, I know it closed above it on Friday, but now can it hold above 120? Then I can see it ultimately moving higher, but wouldn't be surprised if it breaks into this range and then first has to pull back. One thing to note from a momentum perspective, 3-day winning streak on last 3 days. That was the first 3-day winning streak since since June, and that one couldn't have a 4th up day in a row. Previously, though, in May, you did have a 4th green day in a row, and it was a very, very good day. All right, but that wasn't at as much resistance. That was coming off of the bottom. So if it does gap higher, you want to see, can it hold in the green? Does it stay above the opening price? Looking longer term, this stock is, needs to solidify itself within this 120 to 140 range to potentially set up a move back to the 2012 high, above $2. That is what I would be watching for, this kind of 120 to 140 price action. Tomorrow, does it hold the opening price? And then on any dips, you just want to see the highs getting, the lows getting higher. Now solidifying itself, above $1. The higher, the better. If it stays above 110, that's even better than staying above $1. The higher you now stay, the better. Below 115, 110, $1 retest is going to be in play. No reason for this stock, if the bottom is in place, to come back below $1. HIMX. So this is a name that over the last year, if you look, the volume has really exploded. And I really like that from a trading perspective. And while it's off of its 2013 high by a lot, it's up a ton over the last year. You look at where it was this time last year, it was around $1.90. Trading volume on average was, 100K, if that. Now it's just up above $5, off of its high by a lot. Off of its 2013 high at $8.20 by a large amount. But now seems like it's kind of stabilized. Yes, it downtrended from May to June 25th, but since then it's just been going sideways within a channel and maybe now setting up for a bottom and a continuation of the longer term rally. Notice though, it hasn't been able to really rally strongly back above this $5.60 level. Haven't closed above it since July 12th, didn't do it all week. But versus the $5 support level, and I think you can get a bounce and maybe trade this thing back up towards 630. A lot of 4-day losing streaks recently. But if you look since June 24th, closed that day at 539. it's, if you look at its June 14th low, 531, 539 close, it's only 10 cents lower since that time. So even though you've had 3 4-day losing streaks within that stretch, the negative percentage price action isn't showing up as badly as it was with the 4-day losing streak, say in June, where you went at the end of that down to a low of 680, and then 2 weeks later you were down at 530. So overall, seems like it's holding its bottom. The key is holding above Friday's low and $5 overall. Like CPRX with $1, HIMX has the same characteristic with $5. The farther you can stay north of $5, the better it is for the stock. You start pressuring $5 and it becomes vulnerable to a $5 breakdown. Below $5, this low at 476 can be tested. Below that, and then it could really get into some trouble. 476 is key support, but below that price level on a stock that's made a big move over the course of a year, when there's no real floor until 380, it's very important to hold 475 and, in my opinion, just avoid it altogether. As far as the bullish trade, an HIMX, when it gets back above the previous day's high after a red day, then it's signaled a little bit of a bottom the last couple weeks. So watch the high of 530 if you can break above that level tomorrow. Above 530, the key then becomes 550 to 560. Let's just look at that 3-minute again. So HIMX also, another example where the 6-minute low came below the 3-minute low, never could quite get back above that initial 6-minute high. Overall, downward pressure on the day. And if you just look at the daily chart or the intraday chart from July 16th, where you did end up going above that high, but then you came back below and started making new lower days ahead of 10 o'clock, big time reversal. Couldn't hold that move. So if it does make new highs ahead of 945, it then needs to then start holding above the initial 3-minute high. Anytime you go above the initial 3-minute high or below the initial 3-minute low, you then want to see that level act as support. Next stock, EVC. So last 100 days, huge rally, $2 to $6.50. And sideways pattern recently. What's interesting though is you have 3 days, three green days in a row, 3 lone green days in a row, 3 single green days in a row. July 11th, July 15th, July 18th. And that has happened a couple other times. It happened in the middle of May, and that was preceding a bottom in the stock, okay? But you never came below that 3rd green day's low. So this move, though, you're hanging right below it. So this chart looks a little vulnerable to me if you come below this past week's low of $6.44. You look at the weekly chart, haven't then had a red week that closed below the previous candle's low. Since March 2013, and that was only 5 cents below the low. So overall, since this move started, the weekly has just been incredibly strong. But 643, this past week's low, you want to watch, that level. That's a key reference point. If you fall below it, EVC, in my view, is vulnerable to test support anywhere between $5 and $6. I mean, it would really just kind of depend, but I would think $6 is a magnet if you start sustaining a move, coming more than 5, 6, 7 cents below 643. As long as you're holding 643 though, then you're just kind of consolidating within this uptrend, and the recent history would suggest to then expect a further move higher. It does go through long sideways patterns. This most recent one in May went 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, kind of 14 days before it then trended higher again. And then you had a 1, 2, 3, 4, 4-day consolidation, so a little less time then. But then back in April, you had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10-day consolidation. So this one, if you say it's going on its 4th, 5th, 6th, 7th, 8th, it's going on its 8th consolidation day. Tomorrow it's 9th. If you come up on its 9th, 10th day and then break below 643, that's really bearish. But if you start coming on its 6th, 9th, 10th, 9th, 10th, 11th consolidation day, and it's still holding above that level, I think that gives you a nice risk reward to trade versus 643-ish, targeting a move back above $7. EVC is another one where you broke the 3-minute low, 6-minute low by 945, then stayed below it for the most part, ended up trending lower on the day overall. On a very bullish day on July 15th, Monday, you held the 3-minute low, 6-minute low, never closed back-to-back red candles at new lower days. You look at those candles ahead of 10 o'clock, so you never sustained that move, just stayed sideways. Once you started closing above the initial 3-minute high, making new high days, you then had a nice rally from 670 up to 680. Okay, MACK. This is a stock that I usually would stay away from given the big down move it just had, but that's why it's important to look at the longer term picture, because this thing had a big dump, but when you look at the chart over the last couple years, it is a dump at support potentially. This chart looks different than the one I looked at. Sorry, not over the last couple years, but just in general over the last 100 days. You look at the June 6th low, right around 480, and that's where it is now. So if it can hold 480, I like the chances of a bounce. If you do bounce, and then it becomes that over under $5 trade. Right now it's over under 480. Below 480, you can retest this low from May at $4.06. Support above that, which would be important, is $4.40. But overall, below 480, and the support side opens up. Right now, you're at pretty important support, so I kind of like the risk reward for a little bit of a bounce. And you've had a 5-day losing streak. You look recently in the last 100 days, this is the biggest 5-day losing streak. It's the only 5-day losing streak. Last 200 days, it had a 5-day losing streak, which was then followed by a 3-day rally. Had a 5-day losing streak in late October, which was followed by a rally, within the next week or two. So overall, the fact that it's at support, even though it's had a big dump, might be able to get a little bounce. And more importantly, it had a big down day, but if you look at where the volume traded on its highest volume day, it was from 498 to 519. The stock still isn't very much below where all that volume traded. It's about 3% or so. So that's why it needs to bounce here versus 480, get back near $5 to make anybody who bought in on July 15th feel good about their positions. PPHM is one that has just been consolidating for the most part over the last year. So I don't have a whole lot to say about it, but I will say that to me this is an example of a trade that you just kind of stay away from because there's no volatility, and unless the only reason you're buying a stock like PPHM, in my opinion, is because you've done a lot of research on the company and on the drug or medical technology that they have, and you're a believer in that. From a technical perspective, which is what I look at, PPHM has just been in a channel with much ado about nothing. And it just had a big gap down. So if anything, I would say, you may be short this thing given the way it's just hasn't done anything over the last 3 years, but that it is lower on a net basis. But again, this is just something I kind of stay away from because it hasn't gone anywhere. No real trend. Why trade something that doesn't have a trend and doesn't have volatility? You can trade something that doesn't have a trend, but as long as there's volatility, such as MACK, I just pointed out, this doesn't have a real trend over the last 100 days. It's another one that's gone sideways, but it just had a lot of volatility and it's near a support level. All right, moving on to penny stocks now. There are 4 of them, starting with BRND. BRND, what I like here is the volume, the trading volume, and the range that it's been experiencing. Okay, big move higher out of the double zeros and now has solidified itself in the pennies. With penny stocks like this, it doesn't really matter how far off of the high it is. Hit a high of 3.5 cents, 2.7 cents, 2.6 cents. The important thing is that it's in penny land now. It went from double zeros and now it's above a penny. And as long as it stays above a penny, there's the potential for this thing to really still run. And examples of that recently were from NTEK, NTech, which went from double zeros to pennies, didn't do much for a long time, but ended up staying above a penny for months and months and months, and then made a much later move from 2 cents all the way up to a high of 12 cents. So that's my point about BRND, where in the immediate term, momentum, obviously, you're off the high, so it's not there, but from a can this thing make another move again, it's just a matter of holding above a penny now, which is about 30% away from where the stock is, which in penny stocks, 30% isn't a whole lot. We know that these things can drop a lot. But overall, what I will say here is you just had the range come in quite a bit. 141 low on Friday, 177 high on Friday. That's your tightest range since coming above 1 penny. This also gives you a good setup in the immediate term where you really have to hold Friday's low. You can see July 16th low of 1.4, and then July 15th low of 1.3. That 1.3 to 1.4 range is key support on BRND. Where if you go below it, I believe a penny can be tested on the support side, and as long as you hold it, then the potential, I believe, is to bounce back above 2 cents and then maybe consolidate, trend higher overall. On a net basis, good volume took you above a penny. Now you're staying above it. You made a big move off of it. Yeah, you've got some bag holders up there, but it showed you the ability to make a big momentum run. That's a good sign. Now you need to hold 1.3 to 1.4. Below it, you can go down to a penny. A penny stock that then comes back below a penny is very bad. You could have a big dump if, everybody who bought above a penny now thinks they're a bag holder. So, and then, above 2 cents, you've got resistance at 2.7 from the July 15th high. Above 2.7, this thing can go back towards the, yearly high, or the liquid high of $3.50. In terms of resistance, the price was higher at previous prices, but I don't care because the volume up there is so much less than the volume that just traded. So the only real resistance with a stock this cheap, starts with Friday's high, 177, then 2 cents, and then the 2.7 high, and then a 3.5 cent high. Above 3.5, it can go to 5. But again, first things first, needs to be stable right here and fight its way back above 2 cents. NHYT, this is a stock, that just had a nice liquidity move on Friday. You want to see that continue. Nice breakout, but you have to be mindful of this trend is on low volume. Usually I wouldn't cover a stock like this due to the low trading volume because it's kind of tough to trade intraday, but buying and holding has worked on this. With Friday's day though, which was very liquid, I want to see that continue, that liquidity continue if the move higher is going to continue. Otherwise, what looks to be the likely scenario is for just a consolidation, as has been the case after a big volume day that then doesn't continue higher, such as on July 10th. You had volume relative to the previous day, but you just kind of went sideways. The next few days after that move didn't continue. Good chart from a price perspective. Now just want to see it kind of stabilize above 4 to 5 cents is where maybe you start going long. The higher it holds, the better. If it holds above 5 cents, that's even stronger. You can start targeting 8 to 10. Just be mindful, though, that stocks like this that don't have a ton of volume, they're going to be able to have a big drop at some point down the line because there's not a whole lot of volume. Friday's volume day was 10 million. That's $600,000. That's decent. Or not, around 600,000, 500,000 in the stock or so. But in general, its highest volume days have been, even less than 100,000, between 70, 80, 60,000 in some cases. So you have to be selling into the liquidity on the way up. A lot of volume on Friday. Remember, buy, sell for every buy. So some of these people who had been buying over the last couple months are probably leaking out a little shares, but they're doing so in a way where their stock is still moving very nicely. So you can definitely trade this trend. It is a penny stock with an uptrend. Now you just want to see it be stable. Holding above 5 cents is the best case scenario, but overall, as long as it's stable above 4 cents, the trend is intact. LQMT, first thing I see is this big gap down. I see a big move, but after that, most recently, I see a big gap down. So I don't like the gap down, but there's great liquidity. Good trading. Thing traded 38 million shares on Friday. Cheap stock, you can buy a lot of it, and you can get in and out nicely. If you look over the last couple years, though, this is a stock that generally gets pumped at some point and then sells off. Gets pumped on high volume, sells off. So that is why I don't like the gap up. Looks like that move was made and now it's kind of done. You also had lower volume, but just want to see volume remain. Want to see a 40 million share volume pace continued. So LQMT, I believe, from a trading perspective, you got to look at that 15-minute chart. and see that, you know, on the high volume days it trades 5 million shares in the first 15 minutes of the day. So you want to see tomorrow, you want to see it trade 5 million shares within the first 15 minutes of the day to signal that there's good liquidity. An inability to hold 5 million shares, to do more than 5 million shares first 15 minutes, to me kind of signals that volume's moving even lower. That's not good because that's been met with lower prices. So if you can short this thing, I would. If there's another volume drop off, from a price perspective, you know, needs to hold Friday's low of 12 cents. And, you know, if it can bust back above 15, then it can make a move back towards 20. 15 cents is really important. Kind of this 12 to 15 cent channel. 12 cents on the support side. Call it 11 to 12 cents on the support side and 15 cents on the resistance side. Below 11, I would think this thing's going back to single digits. GSAT. This is a nice setup kind of because you've got a low at a round number of 60 cents and you've got a high, you know, at 69 cents just below a round number of 70 cents, you know, most recently. And your June 10th high was 69 cents also. So kind of the question that I have is, does it go to 59 first or 69 first? You know, where does it get back to first off of these 63 and a halves? If you stay above this 63, 64 cent range, start consolidating even higher, you know, above 65, then I think you target a move into the 70s. If you look, you'll see that GSAT has never closed back-to-back, or not, I shouldn't say never, but in the last 100 days, it hasn't closed back-to-back green days above 65 cents at all. So that's what it needs. As soon as you saw back-to-back green days above 65, I think you target a move into the 70s. I like the consolidation of in the last 200 days. You're up near a 1-year channel high. You're actually at a 1-year high. On a 2-year basis, you're breaking above your early 2013 high, and looks like, you know, it might be able to make that move up to $1 if it can, you know, be stable and bust into the 70s. Overall, really nice volume pickup as well. So this is a chart that I would definitely keep an eye on, because I think you can trade it higher. Just needs to hold 60 cents. If it goes back below 60, then some of these supports, you know, 55, 53, 50, those can be tested, and you might have a deeper pullback since you did make a big 100% move relative to where the price was in April. So 60 cents is key. Holding 60 cents, you got to give the bulls the benefit of the doubt. Back-to-back green closes above 65, getting that moving in the 70s, and I would expect a nice momentous move, you know, into the 80, 90 cent range, with $1 not being out of the question in the intermediate term. That wraps up the chart requests. If yours was not covered here, it's either because you requested more than one and I covered the other one, or it was deemed too illiquid by me, you know, meaning it didn't trade enough shares or dollars. Some of you had, or one of you had a question about level 2 reading, and I will respond to you just kind of with a video, because I have some videos on that show how to read level 2. So with that will wrap up the chart review session. I hope everybody benefited from it, and I will, like I said a couple weeks ago, going to try and do an effort to do more of these videos and just seminars in general. So maybe once a month or so. I would encourage those of you who, you know, want more day-to-day live review like this to give my watchhimtrade.com website a try, because this is the type of stuff that I do regularly. However, it is not with lower price stocks. It's typically focuses on Apple, Google, the SPY, Tesla, and Amazon, a select group of higher price stocks. But 7-day free trial with that. So, yeah, are there any questions about any of the setups that I gave you insight on? All right, doesn't seem like there's any specific questions relative to what I covered. I see the request for a video on a 3- and 6-minute guideline I use. I will try and find time to do that. But again, that is something that you ask a Watch Him Trade subscriber, they'll tell you that's something I use exclusively with good success. I'm not taking questions on a stock that wasn't covered. Had to have replied to the email I sent out today for a chart request, just to keep things organized. Otherwise, I'd have everybody in here now requesting a ticker. All right, guys, I will see you tomorrow. Thank you.